Hello and welcome. Today we are diving deep into the latest budget 2024 to break down how it's going to impact your wallet. Whether you're a salaried individual, a stock market enthusiast, or someone looking to sell a property, this video is for you. So let's get started. First, let's talk about what Budget 2024 means for those who earn a regular salary. That is, for those who opt for the so-called new tax regime, which is not anymore new. So for the purpose of this video, let's call this as the default tax regime, where you forego few exemptions and deductions and get the benefit of paying tax at lower rates. Here, we are going to talk about 4 changes. 1. Change in tax slabs. In the left hand side, you have tax slabs before the change, and in the right hand side you have tax slabs after the change. If you observe, there are changes in the first 3 tax slabs after the basic exemption limit. That is, as of now, if your taxable income is more than 3 lakh up to 6 lakh, rate of tax is 5%. This is now being increased to 7 lakh and the rate of tax is going to remain the same. Then we have next 2 slabs. More than 6 lakh up to 9 lakh 10%, more than 9 lakh up to 12 lakh 15%. This is now changed to more than 7 lakh up to 10 lakh, rate of tax 10%, more than 10 lakh up to 12 lakh, rate of tax is 15%. There is no change in the basic exemption limit and other tax slabs. Then standard deduction. So far the limit was 50k, which is now going to be increased to 75k. We'll shortly understand the impact of these changes with a simple example, but before that let's talk about 2 more changes. Third one, tax deduction for employers' contributions to your NPS account under section 80 CCB subsection 2. So far this limit was up to 10% of your salary for private sector employees. It is proposed to increase this to 14% of salary at par with employees of central and state governments. So hereafter you would get 100% tax deduction if the contribution of your employer is up to 14% of your salary. Then the next change is related to family pension deduction. So far this limit was 15k. It is proposed to be increased to 25k. Let's now understand the impact of some of these changes with a simple example. Let's say your salary per month is rupees 1.5 lakh. It's 18 lakh per year. Let's compute income tax before the change. Gross salary 18 lakh. Standard deduction so far 50k. So taxable salary is 17.5 lakh. On this, total tax computed as rupees 2.25 lakh. Let's now see how much tax you will have to pay after the change. Gross salary 18 lakh. Standard deduction is now increased to 75k. So taxable salary is now reduced to 17.25 lakh. And total tax on this income is rupees 2,07,500. As you can see, there is a decrease in tax liability of rupees 17,500, which is about 8% reduction. Now, let's shift our focus to the stock market. Budget 2024 has brought about some changes that would directly affect your investment returns. Here again, we are going to talk about 3 changes. 1. Holding period. 2. Short-term capital gain, STCG. 3. Long-term capital gain, LTCG. Let's start with the holding period. Holding period is the amount of time an investment is held by you. That is the time period between purchase and sale. For instance, let's say you buy a plot of land in April 2022 and you sell it in April 2024. So the holding period here is 25 months. This holding period is crucial because it determines if a particular capital asset is a short-term or a long-term asset, because rate of tax is different for both these categories. As of now, we have 3 different holding periods, 12, 24 and 36 months depending upon the category of the asset. First category, listed securities, holding period 12 months. 2. Unlisted shares and immovable properties, 24 months. 3. Others, which includes bonds, debentures, units of listed business trusts and gold, where the holding period is 36 months. Let's now talk about the change. For the first category, listed securities, holding period is going to remain the same, 12 months. But units of listed business trusts, which was so far part of the third category, is now being moved to the first category. So the holding period is going to be 12 months. Now, what are these listed business trusts? These are real estate investment trusts listed on stock exchange. Here is a list of few such trusts. Coming to the second category, unlisted shares and immovable properties, there is no change. 24 months holding period is going to continue. The third category, others, which now comprises of bonds, debentures and gold, holding period is reduced to 24 months. Now, what is the significance of this holding period? If the holding period is up to 12 or 24 months, depending upon the category of asset, then such an asset would be a short-term capital asset, and sale of such an asset would lead to short-term capital gain or short-term capital loss, STCG, STCL. On the other hand, if the holding period is more than 12 or 24 months as applicable, such an asset is a long-term capital asset, and sale of such an asset would lead to long-term capital gain, LTCG or LTCL. Next, STCG on certain financial assets. Here the change is in the rate of tax. On financial assets like equity shares, equity-oriented mutual funds and units of business trusts on which you pay STT, rate of tax so far was 15%. It is going to be increased to 20%. Let's understand this with a simple scenario. Let's say you buy 200 shares of Tata Motors in Feb 2024 at rupees 800 per share, and you sell this in July 2024 at 1000 rupees per share. Let's first compute LTCG as per existing provisions. Sale consideration is 2 lakh, cost of acquisition is 1.6 lakh, and the difference between these two is your STCG, that is 40k, on which you have to pay tax at 15%, which is 6k. Let's now see how is this going to differ after the change. Short-term capital gain is going to remain the same, that is 40k, on which you have to pay tax at 20%, which is 8k. As you can see, there is an increase in tax liability of rupees 2k, which is about 33%. Next, LTCG. Here we have 3 changes in rate of tax, exemption limit and about indexation benefit. First, let's talk about rate of tax. As of now, rate of tax is different for different category of assets. That is, on listed equity shares, units of equity-oriented mutual funds and units of business trusts, rate of tax is 10%. On bonds and debentures, it's 20% without indexation. For other assets like immovable property, it is 20% with indexation benefit. In Budget 2024, it is proposed to introduce a single rate of tax at 12.5% on all category of assets, financial and non-financial. Next, LTCG exemption on certain financial assets. For instance, as of now on listed equity shares, you get LTCG exemption up to rupees 1 lakh. This limit is proposed to be increased to 1.25 lakh. Next, no indexation benefit. What is this indexation benefit? If the cost of acquisition is adjusted for inflation, then you would have indexed cost of acquisition. In Budget 2024, it is proposed to remove this indexation benefit on all category of assets. So hereafter, you will have no more the concept of indexed cost of acquisition, even on sale of immovable property. We'll shortly discuss the impact of this change, but before that, let's compute LTCG and see what's the difference. For this, let's consider the same scenario, that is you buy 200 shares of Tata Motors but in 2020 at rupees 100 per share and you sell it in 2024 at 1000 rupees per share. Let's compute LTCG before the change. Sale consideration 2 lakh, cost of acquisition 20k. So LTCG, that is difference between these two, is 1.8 lakh. LTCG exemption so far was 1 lakh, so taxable LTCG is 80k, on which rate of tax applicable was 10%, so you would be paying 8k as income tax. Let's now see what is it after the change. LTCG would remain the same, 1.8 lakh, but exemption limit is now increased to 1.25 lakh. So taxable LTCG is 55k, on which you have to pay tax at 12.5%, that is rupees 6875. As you can see, there is a decrease in tax liability of rupees 1125, which is about 14%. Moving on, selling a property can be a major financial decision, and Budget 2024 has introduced 2 changes. One, no indexation benefit, which we have just seen. This is a major concern and you will shortly understand why I am saying so. The other change is related to LTCG. To understand the impact of these changes, let's consider another scenario. Let's say you buy a house in April 2020 for 50 lakh and you sell it in July 2024 for 65 lakh. Let's compute LTCG as per existing provisions. Sale consideration is 65 lakh and holding period here is more than 24 months, so you get indexation benefit. So indexed cost of acquisition is rupees 60 lakh 29,900. The difference between these two would be your LTCG, about 4.7 lakh, on which you have to pay tax at 20%, that is about 94k. If you would like to know more about indexed cost of acquisition, I have a separate video. You may consider watching it. The link is in the top right corner. Now coming back to the topic, let's now see what is it after the change. Sale consideration is going to remain the same, 65 lakh. But because there is no indexation benefit, cost of acquisition would be 50 lakh, and difference between these two would be your LTCG, that is 15 lakh, on which you have to pay income tax at 12.5%, that is rupees 1,87,500. As you can see, there is an increase in tax liability of about 93k, which is 100%. One, if you have salary income and if you have opted for default tax regime, maximum tax reduction can be rupees 17,500, which is about 8%. Then stock market transactions. Here, in case of STCG, you will have to pay more tax because the rate of tax is now increased to 20% instead of 15%. And the reason for this change, as specified in the budget memorandum, is that this present rate is too low and this lower rate is mainly benefiting HNIs. Then about LTCG, there was a decrease in tax liability mainly because of increase in exemption limit, but the rate of tax has gone up from 10 to 12.5%. Then we discussed about sale of immovable property, where we saw 100% increase in tax liability because there is no indexation benefit. Even though the rate of tax has come down from 20 to 12.5%, you end up paying higher taxes. And because there is no indexation benefit, cost inflation index here becomes irrelevant. Then again, the reason for this change, as specified in the budget memorandum, is to ease computation of capital gains for taxpayers and the tax administration. But the flip side of this is you end up paying higher taxes. Does it mean that the government wants to discourage sale of immovable properties? And remember, these changes would be effective once the Finance Bill becomes Finance Act, that is after the assent of the President. With this, it's a wrap on this episode. Hope it was informative. Thank you for watching.